Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. Let's dive right in, take a look, see what's going on today. If you want to follow me, it's at Finance. And if you want to join our community, finding-value.com, where I dive deeper into all these sectors, looking for investment opportunities, sharing those opportunities with everybody in the community. I go over macro, I go over ratios, technical analysis, market cycles. I go over all of that. I think that those things are very important to become a better investor. I also talk about position sizing, strategies in terms of allocations and stuff like that. Specials, the coupon code, if you'd like to join, you get $25 off the first month on the monthly membership. It's only the first month. And a larger $100 discount on the yearly membership, uh, which you can always swap from a monthly to a yearly if you'd like to do that in the future, if you just want to try it out on the monthly for 25 bucks. Okay, so Tim Hack, it says today's movement in the crypto market could be evidence that a major capital rotation into safety is imminent. The price of gold could increase tenfold when measured in Ethereum. The capital flow into gold and silver will mainly come from the stock market, the debt market, and probably also the crypto market. So those are three main markets that money is going to flow out of potentially into precious metals and commodities. Gold will easily reach $20,000 an ounce, says Tim. Some mining stocks will increase 100-fold. Some even 1,000-fold, 1,000 plus X. Here's the thing. I agree with them. Do I think that we could get 100-fold increases and maybe even 1,000-fold increases? I think it's possible, yes. Do I know exactly which companies? 1,000-fold, you're going to need some luck on your side. You're also going to need to diversify probably across a good bunch of companies. Because then you're basically playing a you've got the explorers, developers, and then the producers. You're going to go from exploration to producer, and you're going to have a couple of those companies do that. If you can catch one of those during a massive commodity bull market, that's where you could get the big returns, like the big returns. And there are characteristics that companies have where you can look at, but for the most part, I mean, you got to get some luck on your side there if you're going to go for 1,000-fold gain. It's not going to be an easy one. Now, this is gold versus Ethereum. You can see that we're bottoming. The lows are coming up off of 2022, that low there. You can see that we're basing out and trying to break higher here. You could say that Ethereum's in a topping process potentially, and gold's in a bottoming process potentially. And that the capital rotation event is seen through this ratio. So we are looking at capital rotating into gold and away from Ethereum. In the real estate market, in that cycle, the recovery phase is when a lot of the technology companies do very well. I think crypto is just more or less an extension of the technology sector, the NASDAQ sector. And we could be bottoming here where gold starts to outperform that. So we can also look at XAU USD divided by IXIC, which is the NASDAQ composite. What I see here is a beautiful thing for gold. What I see is a falling wedge. I love my falling wedges, guys. Here's my falling wedge. This is a bottom one and a second bottom. This is a pattern that we see in the markets over and over and over. You see this pattern here. It's also the pattern that everybody shares about market bubbles. So it goes into a bubble. You get like this one here has an extended upward bull trap. So sometimes we get double tops. All that is like the topping here. You get one top here and you get another top here. Sometimes it's down here, sometimes it's up here. That all of these that come up like this, they come up. This is all a bull. It's a bull trap. It's just different variations of it. It's the same thing that we've got going on in this chart here. It's a falling wedge into a double bottom, and then we're going to start to break some of these trend lines. We're going to start breaking them, and then we're going to start breaking horizontal lines that go across. Something like this. We'll start breaking out above those as well. So it's a double bottom, and it's a pattern that we always see on the big long term and short term too. Gold up, oil down. A combination so rare, it hasn't happened in half a century. Markets call it an anomaly. We call it an opportunity, the best setup for gold miners. Agreed. I think it's great for gold miners. I've shared this one, I think, the day or two before. But I also think that gold's going to catch up with time. I do. I think it's going to go up here, where gold goes up and oil goes up, and interest rates go up too. I have a friend that was close to $30 million in net worth, has almost a decade in crypto, lost the whole 30 million yesterday in 10 minutes on cross margin. An entire decade and multiple generations, he could have retired all gone in 10 minutes. 10 minutes. So greed, using leverage and margin, be careful. It makes you very susceptible to volatility in the market. You have to be able to know what you're doing. And usually, if I were to use margin, I would find companies that weren't as volatile. You're not going to make as much on the upside, but you also don't lose $30 million in 10 minutes. That's something that I am not interested in. So people can make a lot of money, but a lot of the times with their gambling nature, they lose it very quickly as well. So it's kind of an all or nothing bust. I think Jesse Livermore was very similar to that. He would short massively, make a ton of money, and then get something wrong and go bankrupt. And he went bankrupt, I think, 3 times, 4 times in his life. And he was supposedly the best trader to ever exist. It currently costs $115,000 to mine a Bitcoin, only worth 113K. Think about that. Well, I'd rather think about this. What if we go into a different market condition? The one that we've got going on up here where gold's going to outperform Ethereum and Bitcoin. What if Bitcoin goes down to, say, like $10,000? And let's say the break even of mining Bitcoin stays around 113,000. What happens then? Does the whole system go belly up? Does the network become unstable? Do people just stop mining Bitcoin altogether? I don't know. That's what I question. What would the processing fees be? Would you trade a $10,000 Bitcoin with $100,000+ fee? I think that's where it's going to eventually end up and fail. That's my guess. We were warned, buyer beware. Number one in overvaluation across the board. 1929, 1966, 1999. You know what those are? Getting stages of commodity bull markets. And there we are again. Those were all commodity bull markets shortly thereafter. 99 was the bottom. 66 was a little bit before the bottom. And then 29 was a little bit before the bottom. But yeah, that's right where we're at today in terms of overvaluation. Peter Schiff says oil is back below $60 a barrel, and CNBC's Jim Cramer just predicted an oil crash. It's got to be the bottom. Time to buy oil and oil stocks. Also, low oil prices are great for precious metals mining stocks. So keep buying those too, in his opinion. I got a lot of oil stuff coming up here because I like oil. I like oil a lot. Um, the reason I like it is because it's cheap against gold. It's I'm not all in on oil. It's a allocation I have. I also have an allocation to gold and silver mining companies, and they kind of offset each other. So the asymmetry is what carries the portfolio higher, and the differences of when these go up under different market conditions balances the portfolio and the volatility to some degree. And I balance it with gold, silver, and then some of the inflation sensitive assets. So here, a dream within a dream within a dream. There's three dreams here on different time frames for oil versus technology. Remember that stock or that ratio I just showed you above? I think it was gold, oil to M2 money supply or gold to M2 money supply, whatever it was. This is US oil divided by the NASDAQ, falling wedge into a double bottom. And then when you zoom in, you have another falling wedge into another double bottom. And then when you zoom in, you're in a falling wedge. So let's talk time frames here. When you trade, and I used to trade a lot of stuff back in the day, you want to go big picture view, which is the first one here. This is a big picture view. You want to get a good chart here. This is the big secular movement, the big trend. You want to get this one and nail this one right. The next one is the intermediate. The intermediate time frame is measured in maybe a decade or so on this type of chart. We have a falling wedge into another double bottom. And then you dive in again on the short term. And we have a falling wedge. Now, this could break to the downside and do what it did here. So US oil divided by, if we zoom in on the right, this could, I'm not saying it will. See this big wick on the bottom there? Sometimes at the ends of these, you get a washed out sale move. Not all the time, but it could. And this is where people get afraid. They sell their shares and offload it to people who know what they're doing, to the professionals. The professionals come in and they just buy it all up. And then they're going to ride this from the bottom up. It's going to go pretty quick up to about this resistance area here. And it could go below it or just slightly above it. It could even do this too. Something on the lines of that will come. And then we're going to see a very big move. It'll go from here all the way up here in some gigantic move like that. That's generally, and then what we're going to see is a pause here in that circle. And then we're going to go up. And if we go all the way up to the top here, I don't think people understand how much money will be made in oil stocks against the NASDAQ in this type of scenario if it plays out that way. If it plays out. And I think it will. Don't get me wrong. I think it will. Because I see a lot of charts that are suggesting something like that could happen. Doesn't mean it will happen. Could happen. Now, this is on a long-term time frame. This might take a decade or 2 decades or something, or 3 decades even. Like it could be a long time where this thing just goes into some major bull market in oil. I don't think it will go straight up. I don't think it'll be violent. It could be. It could do it in a decade, or maybe even less than a decade. But the setup is there. So it's not. A lot of people will look at something and they'll say, Andy, you didn't nail every single call. It's not about nailing every single call. It's all about statistics and probabilities. If you have insanely large asymmetric setups, setups like the gold and silver mining companies, gold itself, silver itself, platinum itself, and there's all these different sectors with this gigantic asymmetry where you can buy them at, I'll just say anomalies on ratio levels throughout history. If you buy them, you don't have to be right on all of them. In fact, you only need to be right on maybe one or two. And you ride it up so much that it will create generational wealth. Life-changing gains is what people will say. What I'm doing is I'm going around and I'm looking at all of these major big trend opportunities that are out there. and then I'm putting some of it in the portfolio. And my weighting, my weighting might be different based off of the opportunity that is presented. A lot of people will say, what percent allocation should I put to oil? Should I put to uranium? Should I put to steel and other ones? My answer is your weighting should be based off of the opportunities that are in front of you right now. Your opportunities should determine your weighting, and companies and how good those companies are, and the technicals and the fundamentals. All of it matters. All of it matters. And I think a lot of people, they just think that you allocate X to and Y and Z to each of these different sectors. Not how I would do it. Every single thing out there is an opportunity that needs to be evaluated. And then you have to say, how good is this opportunity? What's the likelihood that this opportunity is going to be successful? What is the outcome, potential outcome? If the outcome is some ridiculous outcome, let's say that some of these oil companies could go up 10, 20, 30, 40, 50x or more in a gigantic bull market of oil. And we're seeing evidence like this here that I'm showing you in the charts. We're saying, oh, this is a double bottom with a double bottom. This is like a dream within a dream within a dream. Dream one is this big long time frame. Dream two is the smaller time frame. Dream three is the falling wedge and the potential to get fear in the market where you could buy fear and get a really good entry point. And then you have to evaluate your options and the risk of the vehicles that you're going to use. If it's some equities, oil equities, you have to evaluate those risks. And that's what I do on the website. I do all that for you guys. And I give you the opportunities and I tell you the risk. They don't want yields above 4.5%, 5% because of the below. And some people are like, I don't know what this means. Okay, so what this is a dot plot. A dot plot is just data. Think of this as data going over time. So think of it as the 10-year bond yield goes up, what is the correlation between yields and stocks? So yields going up, stocks become uncorrelated as it goes lower. That's the negative correlation at zero here. When they're up, they're positively correlated. So what does that mean? Let's break this down real quick on what exactly this means here. So below 5%, bond yields and equities tend to be positively correlated. What that means is that when yields go up, equities or stocks go up. So they go up together. That's over here. And that is below about 4.5%, 5% is when this all shifts. All in this area here. This is where they're positively correlated. Under here, this is where at higher yield levels above 5%, stocks and US 10-year yields tend to be negatively correlated. So yields go up, the stock market goes down. Now, a lot of people, what they'll say is they don't look at yields. They'll say, yields don't matter. And they'll say, the stock market's going to continue to go up. And I'm like, no, it's not. If you say that, what you're basically stating is you don't know history. This is history. What I am showing you is history. When yields go above certain areas, about 5%, they become negatively correlated. So if we're at a big bull market in yields going up, we're going to see the stock market get hit in the face when yields cross above 5% on the 10-year yield. This is something to watch. This is a big deal here. Coming down, inverted shoulder head shoulder pattern in the oil to gold ratio. I'm seeing a lot of hate on oil right now, and I'm posting big picture view oil charts. Why? Because the opportunities are there now. And it could be a window of opportunity from now to the end of 2025 where we get this window to accumulate oil stocks at the cheapest they've ever been almost. And the reason I'm saying the cheapest they've ever been because this is the crude oil to gold ratio. And look where that line is going across. We're cheaper than entire bull markets before us. At the bottom of the bull market of 99, that's where that circle is there. We are way cheaper on a today's term. And we're right down, very close to a potential shoulder, head, shoulder. Now, this could turn into a double bottom. It doesn't really matter what the name is. We have a falling wedge in a 3-hump consolidation, a breakout, and a retest. Now the retest is just flat, it's floundering around right now. We're trying to find that bottom right where we're at some point here. Can't tell you when exactly, but we're getting there. That's the opportunity. When no one gives a crap about it and fear enters the market, that's when you load up. If now a lot of the oil stocks, the equities, they've already come off their bottoms. They are not at a bottom anymore. They bottomed in April of 2025. The majority did. And they're coming back down on a kind of a big pullback right now, but I don't know if they're going to hit that bottom again. We'll see. The great rotation into hard assets has begun. Metals and miners are finally breaking out versus technology. Paper wealth is peaking. Real assets are just getting started. We won't see a stronger commodity bull in our lifetimes. We won't. I agree with that. And this is a bottoming of the metals versus the S&P 5. Or no, sorry, metals versus technology stocks. This is QQQ. So XME divided by QQQ. And we're just starting to break out of this decade-long triple bottom. Well, it's a double bottom, technically. The way that I view this, and it doesn't matter what it's called. He's right. I'm not saying he's wrong. The way that I view this, a lot of the times you get that falling wedge. Here's your falling wedge. Then you get that's when the buyers equal the sellers. They come into a falling wedge in the beginning, and then you get a bottoming pattern here. The bottoming pattern isn't that important. You don't have to be like, oh, I know what that bottoming pattern is. As long as you're grinding sideways, it's a bottoming pattern. Then you can kind of draw across. The way that I would draw this, that would be like this. It'd be something like that, but you can also draw things across like this. And it's not important, really, what pattern this creates. It's just that you're squeezing up. You're squeezing up, and then you're going to break here, and that'll be in an uptrend at some point. So this is your downtrend, your base, and then you're going to get your uptrend. And you see this all over the place. I could pull up a whole bunch of different stocks. Just as an example, here's URA, falling wedge, double bottom, very similar pattern, and then we're breaking up wave 1, wave 2, and then we are ripping. That's the uranium chart. That chart is beautiful. Here's another thing. When you look at the size of this chart, you can see it's real long here. This bottom was like 4 or 5 years. That means this is going to go up into a big long bull market. It's going to take time. It's not super compressed like the crypto market. You have to get your time frames right on these markets. So that's another thing to consider. Here's another one: gold to S&P 500 ratio and the oil to gold ratio below it. Where I think we might be for a bull market in commodities. A lot of people, they're very anti-oil right now, and that's generally when I get real bullish. So I'm posting a lot of oil charts. When you look at, I'm going to show you another chart below this one, but this is XAU versus the S&P 500. If you notice the circles here, where I put circles, those little orange circles, this is where gold was more expensive, and it started right at the beginning of the bull market. See that circle? So we had a big dip right before the bull market. That's the safe haven asset of gold. The market condition that this started under was a slowdown in the market. And this here, if you draw this in here, this is a falling wedge into a double bottom, and then it broke out. Then we would have falling wedge into a double bottom, and then we're going to break out of this bigger pattern here. Oil was expensive when interest rates went up from the 40s all the way up into 1980s. It was expensive all through here. See that? Gold was more expensive in the 80s, 90s. And then in that last commodity bull market from 99 onward, we had a big surge in oil. I believe that we are at the beginning stages of a commodity bull market that's going to rip. So this is a falling wedge. It's a 3-hump consolidation. We've got a breakout of XAU versus the S&P 500. That's what starts it. That's the starting move. Just like this starting move here, then oil becomes expensive against gold here at some point in the future. That also happened last bull market back here. A lot of the gold equities flew in the beginning of the bull market, and then towards the end, gold outperformed and the gold mining stocks underperformed. Not saying that that will happen this time necessarily, but it could. So we're looking for a move higher in this ratio over the next 6 months or something like that. Here's another one. US oil versus SPX, and I just kept the same bottom there. And you can see we are squeezing up into this corner here, falling wedge ready to break out for oil, outperforming the S&P 500 soon. This is a really long-term chart. So you can't look at this from days or weeks. You need to look at this from years. This is a very, very long-term chart. And it could take a couple of years to really yank out of this bottom here. Now, I like this one a lot. So what I did here is I took interest rates and the oil to gold ratio. This was a declining interest rate environment. And you can see that we started this environment with gold being expensive against oil. Somewhere in this bottoming phase here, and it did take some time, don't get me wrong, when we had a shift in interest rates from a declining interest rate environment to a bottom to an increase, we saw oil during that time frame get more expensive in comparison to gold in an increasing interest rate environment. Now, in this environment, we were in a declining interest rate environment the entire time here. We went from expensive to cheap, hung out with cheap for a good long time. We had a bull market where oil got kind of squeezed up, and then we went back to getting cheap. And I think that this is going to be an ultimate bottom. An ultimate bottom. Why do I say it's going to be an ultimate bottom? Couple things. Interest rates are breaking to the upside. And I think that this is now in an uptrend. These are big long-term big picture view. Now, if this goes into an uptrend, this here is the end of what people think, of the paradigm of what people think about this, between these two lines. This is what they've lived under. So they always think, oh, gold's a spot to be. It's going to be a currency revaluation. It's going to be debt. That's not what it was back in the 50s, 60s, and 70s. Now, they're going to say this time is different. And I'm real careful of that. I think with interest rates going up, I think oil is going to do incredibly well. Incredibly well. I think we're in the bottoming process right now. A lot of people are going to say, well, when is this going to happen? I'm going to say 2026. We'll just say 2026. And there's XLE trying to break out. It matches where this is at here. This is all forming. All these charts, this is interconnected with this, which is interconnected with this, which is interconnected with gold and how it's outperforming the S&P, which is interconnected with the mining companies outperforming technology stocks, which is interconnected with this yields and the equities, which is interconnected with oil and the NASDAQ bottoming and the dream within the dream within the dream, which is also interconnected with the overvaluation across the board, commodity bull, commodity bull, commodity bull, commodity bull, which is also interconnected with this anomaly here. The anomaly is bigger because I think we're at the beginning of the bull market. These were in the middle of the bull market here, and this was at the end. So middle, end, that is the beginning, which is interconnected with gold outperforming Ethereum. Every single chart is pointing to a market condition that I am trying to describe to everyone that's viewing this. That is where the value is. It's understanding the market condition. We're using ratios and technical analysis to determine the market condition. And then the market condition, when that comes and it's applied to humans, a high inflationary environment, they sell bonds, interest rates go up. The stock market and interest rates are correlated in the beginning of the move. Then they become uncorrelated. They break. They go in opposite directions at 5% interest rate. And where are we located? Where are we pausing? Let's look at the 10-year yield real quick. Here's the 10-year yield. I'll get my mug out of there. Look where we paused. Do you think it was by any happenstance that 5% is just above where we paused? Do you think that they're in there doing QE holding this down right now? I don't know. It could be. We just so happen to pause right at 5%. Interesting, isn't it? When you start to know more information, you start to listen to people and things just start to click like this. The cent, we want to keep interest rates below 4.5%, 5%. Trump, we need a weaker dollar. What does a weaker dollar mean? They hold that interest rate down, it's going to push the dollar lower. And then what are we seeing in the currency exchange rate markets, right? We're seeing all these patterns come up everywhere. Falling wedge to a breakout. Canadian USD, BRL USD, Australian dollar, all those commodity currencies. You think that's just by happenstance? You think they're not correlated? Everything I talk about, all correlated, all interconnected. It's like this. All interconnected. All these thousands of charts I show you, it is suggesting certain market conditions are coming. Now, in the short term, they're trying whatever they can to keep people off this. They don't want you on this train. They don't want this to unload. When this unloads to the upside, commodity prices get expensive. That hurts everybody. That hurts everybody who's not in commodities and precious metals. You go to the store, steaks like, $20 a pound. Oh wait, that's kind of what it is. Like you get what we get. And then when you subject the human herd to the conditions of high inflation and an increasing interest rate environment, this is how they behave. That's how money flows differently in the markets. So that's what I've got for today. We'll end it there, and that's all I've got. So we'll see you next time, guys. See ya.